Hello, everybody, and welcome to Selfwealth Live. This is the Traders Edition, Technical Analysis Edition. Hello, Jason. How are you today?
Hey, Rog. I am very well, thanks. All good to go to talk about some charts, talk about some markets, some ideas, and see if we can help out a bit.
Fantastic, and
Take a few
welcome.
questions.
Exactly. Get the questions above. Welcome to everyone. Speaking of questions, feel free to put them in the chat as we go. The earlier we get them, the less time you guys have to spend here watching us, and I'm sure it's a pleasure doing that. But if we get the questions in, we'll try and answer them as best as possible. So thanks everyone for coming along and watching today. So we're going to go through the market review to start off with. Then we're going to talk about market depth, reading the market depth, how we think you should read it anyway, and our interpretation of it. All right. So this market depth is a heavily used function in our platform. So we thought we might touch on it today a little bit. So hopefully that'll help some people. All right. And then we'll obviously have a look at the tickers that you guys sent through, and we can have a bit of analysis of that as well from a technical standpoint. Fantastic, Jason. Let's get going now. Just before I do you want to just talk about the disclaimer, please? Thank you.
Yeah, just a quick note. Everything today is general commentary only, no personal advice given. And just quickly put up the disclaimer we put up each week. The important distinction to make is that I'm not part of Selfwealth. I'm from Motion Trader. That's my business. And you can see that in the top disclaimer, all my licensing details are there. And then below that, we have the Selfwealth disclaimer with licensing details and so on. So yeah, general commentary only.
Fantastic. Now, Jace, before we get going, I wanted to ask you a question because I was pouring myself a cup of coffee before this session, and I've got this cup here, and it says "Work like a boss" or just fake it. All right. Now, this got me thinking about you in your earlier days of trading and being on those trade desks and whatnot. Did they ever? What was it like in terms of a mindset thing? Because I know there's a lot of times when you're maybe starting out in the game, if you don't sometimes think like a trader or an investor or some sort of professional, that could sort of go against you, if you know what I mean. If you know what I'm getting at here. What was it like when you were first starting out there? Did they give you some sort of mindset trading? Was it trying to put yourself in those shoes to become the professional trader that you need to be?
Well, where I started was a pretty intimidating place to start. So I've walked into a dealing room on the 40th floor of the Australia Square Tower in Sydney. And at the time, I think it was the largest dealing room in Australia, and full of smart, successful people, a lot of noise, a lot of hustle and bustle. And I'm coming in at age 21, not knowing really anything much about how markets work. So from that perspective, it's pretty intimidating. There's no real mindset training you can do, and it's very much the investment bank, hedge fund type world. It's very much sink or swim. So it's you probably need a bit of luck to get started as well. That you can sort of be sitting next to someone who's happy to sort of share what they do, and you kind of see who's doing things that might work for you, and then model your ways off them. That's a lot of how my early career started, like finding people who had ways that made sense to me, and then modeling off them. Mindset's mindset's different to trading strategy as well. So mindset is something I guess you kind of you've got to come to terms with yourself around how you action a trade, like actually pulling the trigger on a trade, how you manage the emotions of a pullback where you're giving back profits that you might have made, or losses getting bigger, and the emotional aspects of that. We could do shows on each and every one of these things, these touch points, because they're all so important. It all comes together to make you who you are as someone who can hopefully make money from the markets. I was lucky. I had some really good mentors early on. I started off in the charting department, where I learned all about the price action, and my boss there, a guy called Scotty, started me on the mindset sort of process. And then, as I say, it was about finding others who I could then sort of leverage my learning off. and continue to develop.
Yeah, and I think there's a lesson there, right? Find others that are sort of successful at it. Obviously, my point was not to do a whole session on mindset, but just this cup once again got me thinking about sometimes, even as you're an athlete, Jason. Sometimes you've got to actually step in the mind of an athlete, even if in the back you're not that kind of you're not that person. You've got to step in that mindset yourself to become successful, and you got to fake it a little bit at the start, right? Fake the mindset a little bit until you become successful as well, right? In your eyes, whatever success is, right? So
there's so much modeling, and I think it's in many facets of life. Modeling off, kids model off parents, and you've got to find someone that you're going to sort of like be guided from in some sense, and start to model off what's working. Look, you find what works, you find what doesn't work, and you're trying to model off the aspects which work. And yeah, that's a big part of how I began my process as a trader. But yeah, look, people struggle. I remember the guy wasn't a senior trader. He was a notch below a senior trader, and I was a junior trader, so I was below that again. He had across his dealing screen. This is back when the dealing screens looked like a microwave, the big boxy computer screens. Across the top of it, he had the words "Just do it." So them from the Nike slogan, "Just do it." And I said, "Well, why do you have just do it there?" And he said, "Look, sometimes I just struggle to take the trade. I see the setup. I work out the risk reward, everything's in place, it's good to go, and I just hesitate and I just get trigger shy and I can't place it." So I've written that there to give myself a jolt every time that I struggle to move forward, because I know if I can't take the trade, I can't sit in this room. I don't have a job. I've got to go and do something else. So that was his way of dealing with an emotional aspect which he found difficult. And we'll all have difficult areas we find difficult. Some people struggle to cut the loss. He didn't have a problem cutting a loss. It wasn't working. He'd just bin it. But some people do. And losses become huge issues for them. So work out the good parts you've got to model, the parts you've got to not take on board, and it's a long journey.
Yep, of course. All right, fantastic. Good little bit of insight there. I know we will probably do a lot more training on this because I think it's fascinating myself. But let's get on to the markets, Jason. What does the Australian market look like at the moment?
Okay, well, after a bit of a sidetrack, let's go over to some charts. So I've got the ASX 200. We'll start off with that, and look, three all-time highs last week. So that was on Wednesday, Thursday, Friday, 3 all-time highs in a row, and then sharp pullback yesterday. And I think we need to keep the pullback in perspective. So the ASX 200's had an exceptionally strong period, and that goes all the way back to the lows of October, and just even just looking at the last run from mid last month, it's been a strong period. So pullbacks are a part of upward trends. So it makes the news, of course, when you get a sharp pullback. But in the scheme of it all, it's just market noise. So we shouldn't get too hung up on that at this point. The key feature for me is something we've spoken about many times, is this large range, which has contained the market for two or so years, and we do at this point we've got the breakout. That's what I think we need to be keeping in mind. We've had a big sideways period, and now we're outside of that sideways range to the top side. So from that perspective, I think the path of least resistance, I think, is our base case. The path of least resistance is to the upside. So so far we've had a setting where the dips are finding buying interest. So you just look back at this 50-day moving average, and below that I've got the 100-day moving average. Each time the markets come back, there's been buying interest. So we'll see whether that continues to hold through over the next week, 2 weeks, 3 weeks, and so on as we move forward. And while the ASX 200 remains above the 50-day and also the 100-day, I think there's no reason to believe anything has changed at this point. I'm just viewing this pullback as a return move to the breakout point. So we often get that. We often get when a market's been trading below a resistance band, you get a breakout and then you get a return move. And how long that takes to chop around, we don't know. But, we've got no idea really. It could rebound and be back at new highs by the end of the week, or it could be part of a longer sideways period. Could also test lower towards the 50 and towards the 100 day. We don't know, but we're just at the moment working on the basis that the path of least resistance, until we have evidence to the contrary, is to the upside. So I still want to play this from the long side. That's what I've been talking about for a while now. That's what I've been doing. I've been adding the positions to my portfolio for several months now as we've had this upward momentum. That said, I'm not buying any old stock that comes along. I'm very selective about what goes in my portfolio, and I'm still hesitant to chase stocks that have run really hard, because there's always risk when you've got a market which has been running for a while. Like, yes, there can be a pullback, and pullback could be multi-week, could be multi-month. So I don't want to just buy things which are at really extended levels. My preference is to look for those stocks with fresh breakouts, maybe rallying off a moving average, like the motion trader signals I go through, do the scans. I'm finding ideas in there which are well worth considering. But as always, risk is just one of those things we always need to manage. So I want to trade the setups that stack up from a risk reward perspective, and with my stocks that are running, I'm using those wide trailing stops. And we talk about this a bit, Rog. We talk about those wide trailing stops, which give stocks room to move around, so that when we get these pullbacks, and this is at the moment, nothing more than a blip, but when we get larger pullbacks, it's those wide trailing stops. So they give me the best chance of seeing off that temporary weakness and hopefully staying on a larger trend should that develop.
Yeah, fantastic. Let's hope that this blip above resistance here becomes the new support, right? So new support line with the ASX. And what about the American market?
Yeah, so here's the S&P 500, and it's all-time high on Tuesday, and now we've got a little bit of a pullback. Not much of a pullback at this point. It's just really a down day so far. It's interesting. I just did a bit of a count back earlier today. We've had in the S&P 500, it's had 17 new all-time highs this year, and that's the thing with all-time highs. All-time highs tend to cluster. So when you get one, they typically don't hang out alone. There's going to be more that come, and this is the same when you look at individual stocks. A stock hits a 52-week high. People hear that and they go, oh, it's a 52-week high. It's probably at the end of its run. But often you find that 52-week highs cluster, and one means there's more coming, and that's just the case of when a market or a stock is running. We often see a series of these new high points develop. The pullback in the US so far, it's been shallower than what we've seen in the ASX 200. At this stage, I think the message remains the same as it was last week and for many weeks before that, and it's just a case of let profits run. If you've got exposure to the market and you've had exposure for a few months now, or maybe longer, if you're able to see off this mid-year pullback last year, if you're making money, I think it's always a case of let profits run. That path of least resistance we spoke about in the ASX, it remains to the upside in the US. I think one of the biggest mistakes investors make, Rog, is that they try and pick tops in these markets, and they see it's been rallying for a bit, and they try and pick a top, and they end up getting out too early, and then watching the market run on without them. Mm-hmm. And it's just so hard to pick tops. It's sometimes you get it right, more often than not you get it wrong. You can make a case for tops all over the place, but often the market rolls on, and so that's why I think the best we can do is use it in these situations is to let profits run and use trailing stops that limit our downside for when things do ultimately turn lower. Having said all that, I'm less enthusiastic about buying buying the index at these levels, it just doesn't seem like an asymmetric entry point to me. It's I'm happy to hold stocks through this phase, but I'm becoming a little bit hesitant to buying at these at this point. I don't want to chase stocks that are run hard, as I was saying with the ASX. And we're always balancing risk. Yes, we want to let profits run, but then we also want to make sure that the risk reward stacks up for new positions. I'd rather look for those opportunities maybe from within the S&P 500 rather than just buying the index outright. And I'll show you what I mean just on that point about buying from within the index. This is the S&P 500 equal weight ETF. So like the S&P 500 is market cap based. The equal weight ETF, so the bigger stock is ranked the same as the 500 stock in the index. And what's been interesting with this is that the equal weight has been lagging for much of the last year, and we've heard all about the top 7 stocks, the magnificent 7. They're all the gains are coming from the top 7 stocks. And what's interesting now is the equal weight is gaining a bit of momentum. So you can see it was just lagging earlier in the year, and now it's gaining momentum. And it's also just hit its own all-time high. So it's just surpassed the all-time high from January 22, just in the last week. So I think this tells us that it's not just a narrow rally led by those big 7. I think the strength in the equal weight, I think it's a good sign of market breadth, which I think is positive for the market. It means more stocks are participating in the rally, and you want broad-based participation for a healthy rally or a healthy market. And I think this strength we've got in the equal weight, I think it's positive. It doesn't guarantee stocks will keep rising, but it does. I think what it does, I think it removes one of those arguments the bears would have been wheeling out in recent months, that this rally is only about a handful of stocks and everything else is struggling. The equal weight would suggest otherwise. It's not just a few companies; it's broad based. So rather than chase Nvidia or the top stocks at elevated levels, maybe I'd be inclined to look from within the S&P 500. Some of those less known ones, which are starting to do some interesting stuff.
Yeah, okay, exactly. And just for the beginners, obviously, when we talk about buying the index through Selfwealth, you can do it through ETFs, right? Such as the ETF. This is a US ETF, I believe. There's ETFs on the ASX that track the S&P 500. To Jason's point, you can start looking for companies in that top 500 that are in the actual S&P 500, which I'm sure you can find a list quite easily if you just Googled what companies are currently in the S&P 500, right? Because that changes all the time when they rebalance as well, right? So, it's good stuff, Jace. What about the Hong Kong market?
Just a quick look over at Hong Kong. Continues to look encouraging, holding just in the last week. It's been holding above this support we drew in last week. That comes in at around 16,300-ish, thereabouts. And it's the moving averages have stabilized. Moving averages are showing some tentative signs of starting to maybe turn to the upside, a little bit early on that yet, but it is looking like they have at the least stabilized. What I'd like to see now is for a break above the February high, and that would then the Hang Seng starts to really start showing those early signs of gaining some momentum. What's even more interesting is the Chinese market, and why I think this is interesting in that it's we talked about this last week, this tight consolidation, this compression range it had. So we've cycled from below the moving averages to above, and really trading tightly above the 50-day or the 100-day moving average, with the 50-day below it. In the last day, we've broken to the top side, so we're gaining some upward momentum. Also seeing these moving averages are turning higher and getting close to crossing. Always interesting when a market moves contrary to the gloom. So lots of gloom around China, but the price action suggests that maybe it's worth keeping an eye on. Maybe something is going on there. And of course, there are strategies to take a position in Chinese orientated stocks. We won't go through it all today, but yeah, there's we're no longer trading lower below declining moving averages. There's a potential change underway in this market.
Yeah, that's it exactly. Which it's good, and which is what we talked about a couple of months ago. Seeing this now pop above the moving averages, it's good to see technical analysis actually play out throughout our shows, right? And the way we see it, and we've just got to see. And that one, if you go back to the Hong Kong market, it actually shows the consolidation just above the resistance point there now. So if if Hong Kong market just follows China, then I mean potentially is going to do the same, right? And they might be catching, these markets are benefiting, I'm sure, from the bullish nature of all the Western markets and everything else that's just getting bought up now. Gold, Bitcoin, they're all at all-time highs at the moment, right? So a lot of exuberance going on, whether it's rational or not, I don't know, but a lot of it's going on, that's for sure. All right, there's a question there, Jason, around MAs, and we might just get on that one quickly, about a MA crossover. What time frame do you use in a chart to check 50 days? MA crossover 100 days MA. Any MMA has not crossed over in 12 months chart, but has done in a 3 months. I don't know. Can you make?
No, I'm not quite sure. I'm using 50 and 100 day moving averages as my my base template. There's shorter moving averages that are also interesting to look at. Like I might use a 10 and 20 day moving averages sometimes if I want earlier signals. But for me, I use the 50 and 100. I like to see the 50 day get above the 100 day as a sign of momentum. But look, there's no single best way to use moving averages. All sorts of strategies and timeframes that you can use.
Is NEM a stock? Can we just check quickly? Is NEM a stock?
What's the what is it again?
So NEM.
NEM. That'd be Newmont.
Yeah. So NEM has crossed over in a 12-month chart.
Oh, okay. We're saying Newmont's crossed over. Has it?
Maybe have a look at 12 months. I'm not sure. Maybe the monthly.
Yeah, no, definitely wouldn't have crossed over on the monthly. Well, it's above the 50-day moving average. Newmont's going to take a while to turn around if that's the correct stock we're looking at. For me, yeah, it's too early to get excited about Newmont.
Yeah. Under the moving averages. All right, we'll get on to any other predictions or any other tickers after this, not predictions. Yep. All right. Let's talk about what our educational stuff we were going to talk about today, and that is market depth. All right. Now we get a lot of questions around market depth, and there's a great article that explains market depth in our Help Center guide at Selfwealth. Right. So, but we thought, why not talk about it on video as well? So I'll post that link up on that article with this channel, with this YouTube video. Sorry. But in the meantime, Jason, what's market depth? What is market depth?
Well, last week we spoke about liquidity, which is essentially about how hard or simple it is to buy and sell shares. Can you get in and out easily? And market depth is quite connected to that. A little bit different, but it is very much related. Market depth is really all about how many buyers and sellers are on either side of the market and where they are, and how many shares they're offering at all the various points on the bid and the offer. And market depth is one of the things I always look at before placing a trade. I think it's really important. It's a really important thing to do, especially in stocks where there's maybe lower levels of liquidity. But I've got a good example for you later on where it's a larger stock where you really still needed to pay attention to the market depth. And so we can go through and check all this out. But yeah, that's the key to market depth. Just think about if a stock's trading at $1, you're going to have a bid at $1 and then at 99 cents, 98, 97, and so on down. You'll have bids all the way down, and on the flip side to that, at $1, $2, $3, and so on, you'll have the sellers. And depending on how much stock's available at each level, that's essentially your market depth.
Yeah, and of course, the buyers are always wanting to buy as cheap as possible, and the sellers are always wanting to sell as much as they can, right? So that's why there's the flip. Well, let's have a look. Where is this market depth on our platform, Jason? And maybe we can have a couple examples.
Yeah, so let's go and do that. So this is I've got this set up. This is inside my account, and so I've got I just typed in BHP, typed in the biggest stock to get started with. Sharing the screen always does help, doesn't it? Let me just go back to that. Where are we? There we go. So yeah, so there's this is inside my account. I've typed in BHP. This is the market depth for BHP, and you can type in whatever stock code you want, stock search. You get a stock, and you get all the details you need. So market depth is just down here to the right. And of course, if you use a different platform, if you're not using Selfwealth, chances are they're going to have market depth there as well. Of course, you've got to go and find it yourself though, because it's going to be a different setup. But market depth is a common feature across most platforms, I would think. So clicking on market depth and just coming down, and as I was saying before, for BHP, so we can see the current price is 42.58, and we look at the bid, the buyers. There's a bid at 42.58, and there's an offer at 4.59, and you can see the quantity on either side, plenty of quantity on either side. So it's going to be an easy one to transact in. And there's lots of depth because you can see every cent below. There's plenty of volume either side. Total number of buyers, 1,398 for 792,000 odd worth of stock to be bought on the buy side, and then on the sell side, you've got the same information. So this essentially tells us BHP is a big liquid stock, which we already know, but for the point of the example, you can see what makes a liquid stock. This would be similar for probably most of those ASX 50 stocks. So you can place an order, get filled at your price pretty much instantly. Now, let's go to the other end of the spectrum. This is a stock which I had cause to look at recently because it came up as a motion trader signal. So I was looking at what was the market depth situation in the company. A company called Joyce Corporation. It's not in the All Ordinary, so it's not in the ASX. So it's not in the top 500. So it's a smaller stock. And I didn't look up what the market cap is. So market cap's probably under 100 million. And wonder whether we can see it in the overview. Market cap, 100 million. So it's a 100 million market cap company. So it's not an insignificant company by any means, but it's smaller. Click on the market depth, and quite different to BHP. So last trade was $3.57. The bid is now $3.31, and the offer's $3.58. So we've got a 23-cent spread between the bid and the offer. And there isn't bids at every pricing point below. So the next one is 3.30, then it jumps to 27, 25, 22, then it drops off to 3.11. And you got a similar situation on the buy side. 22,000 units on offer altogether, 38,000 units on the bid altogether. So would call this a liquid stock. And this is this is why it's important to know your market depth before placing an order. You just got to know what you're dealing with. So to trade in a company like Joyce, it could take a few days to buy or sell a position at an acceptable price. And there's more risk, as it's probably going to be harder to sell. So even if you just want to trade on the bid and the offer at the moment, buy at $1.54, then you're selling a minute later at $3.31 if you needed to sell straight away. So it's a wide spread, so it's harder to sell at your price. So to trade in a company like this, there's still a case for it. There's still a case for trading in these companies with less liquidity. But I think for me, I want to make sure I've got plenty of upside potential to justify the extra risk. And as we were talking about last week, Rog, low liquidity, it doesn't mean a stock can't be traded, because some of the best trades can be in these lower liquidity stocks. And I think one of the advantages for a lot of retail traders is that they're trading in smaller volumes, so they're nimbler than a fund. So a lot of few funds are going to be able to trade in a company like Joyce. It's just not the volume there. But if you're a retail investor, it is possible. It is possible to trade these stocks, manage your risk, trade in smaller quantities. You can move in and out of these companies. And this is where my philosophy of the many relatively small trades comes in. So in a portfolio of maybe 50 stocks, a smaller, less liquid stock could have a place. It might be 1/50th of a portfolio, or maybe even less, 1/100th of a portfolio, but it can still make a difference if you get some good upside potential in them. And we do see this in some of these smaller stocks. So just about understanding the risk and understanding how you're going to manage it. And a strategy I often use when I'm trading in a company like this, and I do trade in these stocks, it's I'll often put in a bid. So if I want to buy Joyce, I won't come in today and pay $3.54. I might put in a bid at, say, maybe somewhere in between. I might go for like $3.45, $3.46, something like that. So I'm above the bid, but I'm not paying the offer. And then it's a case of waiting for someone to come along and want to sell, and they're just selling with the bids, and that's how I can get the stock in these companies. But of course, there's always a chance that you don't get filled and a stock like this moves on without you. I'll show you an example. It's good with an example. So I'll show you the stock first, then we'll come back to the bid and offer. So this is a uranium stock. This is a uranium stock that I was, it's a locally listed one. I was trading in, I bought a stake in not long ago. And you can see just by looking at this, it's a low liquidity stock because it's all dots and dashes on the price chart. So I've just circled the area where I bought. So I looked up my details earlier on today just to get the right dates and details. And it was the 28th of July last year. So I had a signal to buy this stock. And it's when we look a little bit close, you can see the ranges can be wide. It was a bit like Joyce in that you got a big spread between the bid and the offer. I didn't want to pay the offer, so I thought, look, I'll put in a bid and see if someone wants to sell in the next few days, and I can pick them up. So I wanted to buy about $16,000 worth of stock, and I didn't want to pay market because I didn't want to just pay the offer because it was it's a wide spread. So I placed an order about 20 cents below the bid, and it was on the low. It was on the low of this day on the 28th of July, and I got filled, but for only about half of my position. So I ended up with about $9,000 worth of stock instead of I think I ended up with about 10,000 shares. I wanted almost double that. So this is the thing, when you just place a bid, you don't always get set, and it's a shame because then you can see what the stock's done. It's a lower liquidity stock, but it's gone on quite well. So it's up over 60% at the moment. But that's the thing when you're trying to manage risk around these less liquid stocks. Sometimes when you place a bid, you don't always get the stock. But as I say, we're always managing risk. It's about just paying the offer doesn't always give you the right outcome, and we never know. We only know in hindsight what the best entry strategy is. But that's one of the ways I think where we can sort of get involved in these smaller stocks without crossing wide spreads.
Yeah. All right. Did you want to just quickly go to the market depth again, and just show people that there's like the different, like you can click the down arrow on those market depths. Maybe see, obviously, with this is a very liquid stock, so there's only one order per line there, right? But if we go to BHP, I'm not sure if you actually click the down arrow on the left hand to see all the different orders under that price level.
Right. Yes, I see what you mean. Yep.
So just to just show people that they can actually see their own order in the market depth. So when they put I don't know if you've got an order in market at the moment, Jason, as an example, but all these are people's orders on the exchange, right? This is not just on Selfwealth. This is on the exchange overall. So you should be able to see your order highlighted. It'll be green, and you should be able to see your order in there. So you can click into your order and edit your order, whatever it is. But just that's how you can see all the different shares, the shares and what people are trading at different levels, different prices, right? So I just want people to know that that's there as well. Often we see clients don't know there's a little arrow there that they can actually see their own orders, and there's a whole bunch of other orders. So that's actually a total. That one up the top there, that top level, is a total of all the orders underneath that arrow, right? So yeah. All right. Is there any other examples, Jace, you want to talk about at all?
Yeah, it's look, I think one of the important things with market depth is that it can really help you decide what type of order you're going to place. I think a lot of people will just place an at market order when they want to buy a stock, and that can be okay when you want to buy $5,000 worth of BHP. Sure, buy it. Almost all the time, buy it at market. It's not going to be a problem because there's 4,600 odd shares on the offer at 42.54. So you're almost guaranteed you're going to get set for your $5,000 shares at 42.54. Not a problem. But I'd never place an at market order when the market depth is patchy and you don't have such high quantity on the offer. Or the bid for that matter if you're selling. And even in some larger stocks, there can be times when the market depth isn't always suitable for just selling it at market. So I'll show you an example. So this is I'm going to show you an example from JB HiFi. So everyone will know JB HiFi. It's a large stock, about $6 billion in market cap. And so now I'm going to go, so this is a daily chart. I'm going to go to a time in February. It's this day here. See this big up day in February? They just announced some results, good results. The market started moving up quickly in the early market, and people are digesting the result, and so the volumes dropped away a bit while there's some consideration as to what's going on. What I'm going to do, we're going to go to a 1 minute chart. So let me just come in on, because I want to look closely on that particular day. So let me just compress all this price action up, and we're just going to step back a bit whilst I find the day. And where are we now? We're 14th of February, so we're nearly there. And here it is here. So let's just blow that out a little bit. So yeah, now I want to focus in on these two spikes lower. So what appears to have happened here, there seems to have been a seller that had two parcels of approximately around $150,000 worth of shares. And what appears to have happened is that they've gone to sell at market. So even in a larger stock, if you place an at market order, you don't necessarily get the price which you're currently seeing on the screen. Once that order goes into the market, it will just go clunk, 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 and all the way down that bid column we were looking at until your volume's filled. And it's interesting that on both occasions, it stopped at the selling stopped at $58 even. So maybe it was a practical at market sell, but with a limit of 58, which was a reasonable amount below where the current market was. That's why I say it's practically at market, but with a safety level of 58. So on this first excursion to the downside, market's come away 2.5%. Then on the second one, it's come away about 2.1% down to that what we think might be a 58 limit. So the good thing this person, or whoever placed the order, did is that it appears they did put a limit on, because if there was no limit there, well, there's no saying it had to stop at 58. Maybe the order would have been filled even lower down. So this is why putting a limit on is really important when you place your order, particularly in stocks which are less liquid, and even sometimes in larger stocks, although most retail investors won't be selling $150,000 worth of stock. But as a general course of operation, I think a limit is a sensible and prudent way to transact. And what would have been better on this occasion would have been to just feed that volume into the market over the space of a few minutes, and it would have probably given a better result than just here it is, a big clump of shares, sell, and it just goes down through that bid column as we saw. So that's why I always use a limit when I'm buying or I'm selling. I'm almost always using a limit because I want to control the sale process. I don't want a disorderly exit or a disorderly entry where you're just hitting whatever is on whichever column it is that you're operating in. I'll give you another example. So let's go back to a daily chart. This is just from it might have been last week or the week before, maybe a couple of weeks ago. It's a company called Doug Technology, DUG, and this is a stock which I own myself. It's one of the motion trader stocks. So the initial entry point's back here in sometime last year, early last year. You can see the moving averages cross, breaks to a new high, triggers an entry signal. So I bought some. My motion trader members, some of them are in. We've had this nice upward trend. There's pullbacks along the way back to the 50-day moving average, back to the 100-day moving average, a little bit below. But we've got the trailing stop, which is coming up beneath the market. Hasn't hit the trailing stop, so we've given it that room to move. Now, what I want to look at is this day here. Look at this spike lower in the share price. And now we don't know the story behind it, but it was a results morning. The company's put out results. For whatever reason, someone's felt the need to sell, and it looks as if they've done a sell at market, and we've got this spike lower. And we can look at it on a 1 minute chart as well. The 1 minute charts are interesting for looking at this sort of thing. Let's go across. And so the results have come out. Maybe the results came out before the market opened, because you can see the market's just opened down. How much is open down? Market's open down 22%. So then we've got a whole lot of stop loss orders being triggered as well. It's only taken 2 minutes to find us low until cooler heads have come in and said this is an overreaction, and the buying started, and prices started moving up. So an at-market sell in a stock with lower levels of liquidity, it's interesting. Let's just have a quick look at DUG and see what the liquidity is like today. Of course, it's a different day, but generally speaking, look, there's you just cast your eye down there. There's for a retail trader, there's more than reasonable liquidity to be buying and selling into. But if you're selling maybe $100,000 worth of shares or more, it's going to go clunk, 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 and just start absorbing all these bids, and you get that rapid decline. And because the results have just come out, probably the bids are even thinner. So that's one of those things to be aware of. So two really important lessons to take from this, I think, Rog, is firstly, use a limit. Use a limit when you sell, even if it's if you need to get out of something, give it, maybe you give a bit of room on that limit, so you've got to do a bit of selling space, but it's not just sell at any level, because sell at any level, seriously, you can be selling at a level you didn't expect to be selling at. And the other thing, and this is something we talk about all the time, it's why I use wide trailing stops. People often who don't understand the strategy so well, they say, look, why would you use a wide trailing stop? Why not just have a 10% stop loss or even a 20% stop loss? That sounds pretty excessive. But you're using a 10 or a 20% stop loss. Let's see, from the high point, there's your look, there's your 10%. So 10%, you're basically not being serious. You got no chance of staying in a stock like this for more than really a few days on most times. A 20% stop is down here at the 50-day moving average. This stock opened down here at $1.90. So your slippage, you're probably out at down 30%. It's it was a big one-day move, but a wide trailing stop, I'm still in it. Didn't trigger my stop. My motion trader members, hopefully they're all still in it because it didn't trigger the stop, which is a bit lower. And yeah, this is why we use wide trailing stop. You're seeing off volatility and these unexpected actions from others where they might place at market orders and cause a market to spike.
Yeah, very good. Look, I like these examples, Jason. It sort of shows people a little bit what's happening, in these markets when we have these spikes as well, which is great. And understanding that if there's someone puts in a caveat to a bit of the thing that I said before about how all orders end up on that market depth. If an in market then limit order goes in, you won't see that on the market depth. It'll just take out all whatever's there on the bid or the offer, depending on what side you are, right? So you're not going to see a market order until it becomes a limit. Let's say it's partially filled or something, that it might end up slotting in. But yeah, there's a lot of, and some of the questions are coming in talking about institutions and things like that. There's a lot of dark liquidity out there that don't end up on the market depth. So you don't see it all, but it's a good indication of what's out there, right? So yeah. All right, let's get on.
And that's why I do place, when I'm trying to get into some of those less liquid stocks, I will place an order which is maybe, depending on the stock, 10 or 15% or 15 cents, not percent, about maybe 5 tenths, 10 cents, 15 cents below the offer, because I do know there is a reasonable likelihood that someone's going to come through and just go sell, and it's where I can pick up stock, which is otherwise just a little bit fiddlier to collect, or a little bit more expensive to take on if you're paying someone else's price.
Yeah. All right. Let's get on to, this is some great info there on market depth, and it's worth rewatching. But let's get on to some questions here, Jace, before we get onto the tickers, and hopefully we can answer them within reasonable time, because I know we're coming close to the time again. But how can you find out if trades listed institutions or larger players or retailers? Is that easy to find out?
I don't think you can. It's anonymous, isn't it? Yeah. It's just bids and offers on the screen. You don't know who's there. Sometimes it's interesting. I'll see there's 500 shares on the offer maybe in a smaller stock, and I want to buy. So I want to buy 3,000 shares worth of stock. So I pay that offer for 300 shares. And all of a sudden I'm filled, because there's actually more than 300 shares sitting behind there. There's someone's trying to lighten or sell down a position in a smaller stock, so they won't put their whole quantity on the offer. They'll put a portion of it there, and I only discovered there's actually more stock there when my order's filled in an instant, whereas I thought I was only going to get a portion of it, but the whole thing's filled. So you don't know. You don't know what's sitting off market, which is ready to come on market.
Yeah, unless you've got some insider information that we don't know exactly. There's one here. Market depth is market bid is like an auction. I would say yes, it's very comparable to an auction. As in, is that house auction? Maybe is that what that's asking? Market bid is like a house auction.
Would this be the open we're talking about, do you think?
Well, we're just, you're bidding. This is how I'm interpreting this question. You're bidding on, if you're bidding on a house, yes, you're bidding. You're the buyer, right? You're the one that's bidding, putting the prices up. Buyers are always putting the prices, trying to go lower, as low as they can. And sellers the opposite way. So, the bidder of an auction, and then you've got the offer, the people that are offering
Yeah.
the
But
house.
what's different to an auction is that the highest bidder doesn't necessarily get the shares. You've got to wait for someone to then say, okay, well, I'll trade at that bid. If we're talking about a stock where there's a wide bid and offer, the bids will keep creeping up. So the highest bidder will put themselves in the position to get the shares, but then you need someone to come and hit the bid.
Exactly.
For most stocks that we trade tend to be, there's a 1 cent bid and offer spread, particularly in ASX 200 stocks.
They're liquid stocks, exactly. Now, we might have a look at this question next week, because I'd maybe market cap is useful. I'm not sure we spoke about market cap today. We talked about market depth, useful, but what about the number of shares on issue and the price of those actually tradable, not held by founders? I'm not sure if that's on topic. So we might have a look, revisit that for another session. We don't offer CFD leverage trading, just physical market. Sorry, Irfan. What is your take? What is your take when there are more buyers and a higher volume than sellers, but obviously not all high enough price to buy? Can you infer the price will go up, or just lots of support? Does that make sense?
Yeah. Look, it'd be fair to make. I think it'd be reasonable to make that assumption that there's interest in buying it, but it doesn't guarantee. Like, for instance, I think I can quickly show you an example. Let me just jump back into this. There was another stock I was looking at. It says Schaefer Corporation. Let me just go down to market depth. Oh no, it's changed a bit. There's only there's not much either side. So no, that's not going to be an example. Let's go back to this one we had earlier. Well, there's almost twice as many buyers as there are volume. Not quite, but the volume is more than almost twice the level of selling. So look, maybe that's a positive, but I don't know that you'd base an investment off that. It's something you might take on board and feel a little bit more comfortable buying, knowing that there's not as much interest in selling as there is in buying. So yeah, at the margin, that's something which is of interest. But yeah, it's the other things like the moving averages and the price action, which for me is number one.
All right. There's quite a lot of questions here about market depth, so we might just if we get time, we might get onto a few more of those. Otherwise, we may revisit some of these questions next week, because I'm just conscious of your time and everyone's time, obviously, Jason. Let's have a look at some stocks. Let's have a look at Apple first off. What do we think Apple's looking like?
Right. Okay. So let's go back to the charts. Yes, let's just compress this a little bit, just get the overall picture. Well, we've got this big rally from pretty much throughout last year, through to July last year, and we've had this sideways consolidation since. So you'd say that we've had the strong rally. Now we've got the sideways compression. How is this going to resolve? Is this building some sort of a topping formation, or is it just going to continue sideways before breaking up again? And look, there's no way to know. I'd say that overall the overall trend would be upwards and in this. From a short-term perspective, it's not a level I'd want to be buying it, because price is below those moving averages, and it's at the lower end of the range. For me, this is one to, if I own this one, I'm continuing to hold it, but I'm not buying at this point, in case that whilst we're below the averages, it pulls back further. But overall, I think this could be constructive, in that we've had a big rally and we're having it going sideways. We've got to see how this sideways resolves. Does it resolve to the upside or the downside? I'd have a bullish bias on it, but it's not one I need to come in and buy today, but it's one I'd be holding if it was already in the portfolio.
Okay, fantastic. What about GDS?
GDS. Do we know whether that's a US stock?
Good question. I don't. If it doesn't show an AS, must be. Let's try that one. Yep.
So GDS.
That top one. Yep. Nasdaq. Let's have a look.
Yeah, I wonder whether it is. It's look. If it is, it's a stock in a lengthy downtrend, which has had a good day. It's up on some news, but look, that's not the sort of situation that I'd be playing. You can get turning points that develop, but it's still too much risk. There's nothing to say it can't then quickly reverse, and it's back at a new low within a month or two. So for me, that'd be a stand aside, unless somebody had a special liking for it, and then it's a case of, well, do you buy now and put a stop below the recent low, which is about, say, 30% stop loss. If someone liked it for some reason and is happy to risk 30% for whatever upside they think is possible, look, maybe you can build you can build a case, a trading case around it, but there's certainly substantial risk with it by just putting a stop below the recent low. So for me, not one for me.
Not at the moment. All right. JD. JD is another American stock, from what I understand.
JB.
No, JD.
JD.com, I guess it is.
Yeah.
Look, it's a similar situation to the previous stock. It's just a long downtrend. Like, the downtrend could end at some point. Might not. The stock could get delisted, so a downtrend doesn't have to end in an individual stock. But it's like, well, there's many points we've seen previously where a downtrend could have ended, but was just a temporary low before a continued downtrend. So at this stage, there's not enough to go on to say, look, this is a turnaround situation, other than for a speculative buy. But even if it's a speculative buy, I think you've got to have a point where you say, okay, the speculation's not worth continuing with now. I'm going to exit, and whether that be below the low from March or below the low from early March, it's someone's got to work out, look, how much they prepared to risk for what upside they could get. It's punting a low. So for me, I'd prefer to leave it.
Fair enough. Let's have a look at CLX. It looks like Aussie stock. There was another.
Yeah. This is certain. Well, it's interesting because it fits that low liquidity theme that we've been speaking about over the last couple of weeks. It's certainly patchy, and I think it's a stock which I've had a position in at some point in the past, because we get a nice upward trend. So I do remember the code is a stock which has triggered signals in the past. Looking at it now, look, there could be a bit of a base forming around that $1.40 sort of mark. The moving averages are crossing, prices above the moving averages. So it's a stock which I think is interesting. It's had the big upward period, then it's had the sideways consolidation, with the potential to move higher. So yeah, that's a stock I'd consider. I guess someone could buy it at current levels, and you're trying to manage your risk maybe around these lows, which is could be various points, could be about 13% or 17% lower, and you look at your upside up to new highs, 40% plus, probably. Yeah, so it's asymmetric, and it's in its nature, or waiting for the recent highs to break, just giving a little bit more room. Does it get up to $1.61 thereabouts? Buying into a little bit more momentum. But being a more thinly traded might be harder getting set when you're paying the offer. So, but a stock with prospects.
Okay, fantastic. There is one there. Well, this is an example of 150 liquidity SXG. Let's have a look at that. It says show SXG as this is an example. 150 million liquidity, please. Let's have a look at SXG.
And this is a gold stock. It's actually one which I've got in my portfolio. It's a motion trader stock. Moving averages crossed back in September. The entry signal wouldn't have been until it made a new high in October, and this has been a nice trending stock for the last few months, breaking high with gold. And just because a stock has 100 million market cap, there's going to be varying levels of liquidity. There'd be some $100 million companies which are really patchy and difficult to get in and out of, and there are others which are highly liquid. There's lots of activity because people are interested in trading them. This is an example of a stock which does have pretty good flow of liquidity, particularly for a retail investor to be able to get in and out of. So it's a situational thing to be just to check with each stock. There could be a stock with 80 million market cap, which you can still get into and out of without too much hassle. So don't think so much about the market cap, although the larger once you get in billions, chances are it's going to be pretty straightforward. But don't necessarily just say, look, it's a $100 million market cap, it's too illiquid. Have a look at the market depth, because you might be surprised. Some of them do have good activity levels. Case in point, Southern Cross Gold.
Okay, fantastic. PPM.
EPM?
PPM.
Oh, PPM. Pepper Money. So this is a recent motion trader signal. So we've got this situation with the moving averages being positive, being to the upside, price breaking to new highs. There's the potential for an upward trend to develop. You can press the price action a bit. You can see that it's come from higher levels. Disappointed the market gapped lower and continued to trade lower for several years. Is the worst over? Is it turning higher? Look, you just can't be sure. Gave an earlier buy signal. I've got this circled because I would have been talking about this at some other stage, where it gave a buy signal, and this would have been the stop loss. So triggered an entry, triggered an exit, and you're going to get that. You're going to get breakouts. You get setups which have potential, but then don't deliver on that potential. What this one will be like, we don't know, but there's certainly potential there. There's asymmetric potential there in that you can manage the risk on this, but the upside is, a lot higher. Whether it fulfills that potential, that's what we don't know. But you play situations where your downside is you lose $1, your upside is you make $3, and you keep playing that game over and over again. And if you're getting roughly half of them right, maybe a little bit less even, maybe even just getting 40% of them right. If you're losing $1 when you're wrong, making 3 or so when you're right, you do really well. And that's what it's all about. So we don't need to know which setups are going to deliver the big payoffs. We don't know. So we spread our risk. We get a portfolio of asymmetric setups, and we see which ones run. And statistically, if you just keep playing it over and over, and you know that setup does give you that asymmetric tilt, well, you should do well over time. Although from a stock to stock case, we just never know.
Okay, what about PLS? Last one around PLS.
PLS, it's still range bound, really. It's been range bound for ages. We've talked about this a few times, but look, we're above the moving averages again, so it moves back into that prospective time where you go, well, look, maybe it has now based, it has done enough work, and it is going to start making its way back up towards the top of the range, maybe beyond. So if I was to buy PLS, now's the time where I probably wouldn't buy it now it's at the point where it's something to be considered, because it's gone from below the averages to above. The averages haven't quite crossed yet. Prices pull back to them. So it's one of those ones which we often see where maybe it just tracks sideways into the averages and then starts to rally again. And that's probably when I'd get interested if we get a bit of sideways and then we start getting a lift off the moving averages. I'd probably be interested at that point. But it's shaping up. It's certainly one to watch, and it's certainly got potential.
Okay, fantastic. All right, I might wrap up there, Jason. There's one more stock, but it's in the European market. It was the RWE on IBIS. Let's have a look quickly, and we might wrap up on that one. Like I said on the chat, there's quite a few questions in there, which means we'd probably go to 2 hours here. So as much as I'd love to do that.
Problem is, I don't know which one this is.
There's a few in there. No, that's okay. If
it were this one on the German exchange, it's like, it's not one I'd look at being below the averages. Looks like it's stretched and it's ready for some sort of a rebound. But it's I wouldn't be investing in a stock based on it looks like it's stretched and it could rebound, because then it could just then steady again and fall. There's nothing here for me at the moment.
All right, fantastic. Jace, thank you very much for your explanation around market depth today. It's much appreciated. Thank you guys for sending in your questions. Like I said, if we haven't answered, I'm trying to collate some of these questions and we'll add them in over time just to keep you guys continuing to watching as well, right? But as they say, to be continued. Please continue to like and subscribe on the channel or the video, and send comments through the video. We'll be sure to try and answer them in a future session as we go, right? So we really appreciate all that. Any other feedback or commentary, Jason, or you happy for today?
No, I think we're done. Thank you everyone for coming along and joining us.
Fantastic. All right, everyone. Thank you very much for your time. Have a good day. Bye-bye.